Hey, everybody, welcome back to the Teaching Tax Flow Podcast, episode 125. We are looking at DSTs today. That's right, DSTs. But before we do that, let's take a brief moment, as always, and thank our episode sponsor.
This podcast is brought to you by Strategic Associates. Are you a high-income earner, real estate investor, or successful entrepreneur who is frustrated by having to pay $75,000 or more of annual tax liability? If so, Strategic Associates can help. Your first step to saving thousands, if not hundreds of thousands, is to contact Roger Roundy at roger@strategicag.net or by calling 801-641-2956 and be sure to tell him TTF sent you.
All right, everybody, back here on the Teaching Tax Flow Podcast. On this episode, we are going to dive into DSTs, so those Delaware Statutory Trusts. If you don't know what that is, good. You're in the best place to learn about it. Chris Picciurro, welcome back to your own show, sir. How are you doing today?
Well, thanks for having me back, John. I appreciate it. I am doing great. We know this weather is warming up around the country, and this is kind of the, it's kind of a fun time of year, but I am really excited about this topic. It's something that we've been wanting to talk about for actually quite a while. And, we spend a lot of time planning our content, but really excited to talk about this strategy this week. We have an amazing special guest. But other than that, I'm doing great and, excited to jump in. And
you have to say something about the weather, right? Because obviously you're down south, I'm up north. You say it's warming up. It is still warming up, but it's still below freezing for me, good sir. So one of these days I'm going to have to shave my beard off just so I don't get icicles growing in this thing. But in the meantime, we'll talk about something that people actually care about. So these DSTs, Chris, I'll let you introduce our guest here. Again, I'm really excited about this one too, to kind of echo what you said. It's been on our kind of ever-evolving roster for probably well over a year and a half. Where we've just been looking. We've looked for a great guest to speak on it, somebody that knows a lot about it, eats, breathes, lives, sleeps, everything about these. And I think we have that person. So I'll let you take it from there.
You are correct. And we talk in Teaching Tax Flow about legally and ethically reducing the tax you pay in your lifetime. We've had an episode on what's called a 1031 exchange. So for those taxpayers that fit the avatar that, maybe they're repositioning their portfolio, they're selling property. We know one of the three laws of Teaching Tax Flow is that tax agencies are your involuntary business partner. Tax laws are written to encourage and discourage certain behavior. Hence, we always talk about how real estate is an asset that the government encourages us to invest in because of the tax breaks. So one of those big tax breaks is a 1031 exchange. And a 1031 exchange, we're going to dive into that in a little bit. We also have a full episode on that and a lot of content on our YouTube channel on that. But for someone that maybe wants to sell an asset, reposition, and they're sitting on to a large taxable gain, but they don't want to pay tax on that. Maybe they just want to keep that money going and reinvesting into real estate. This is a great opportunity. And so we're going to build on our previous knowledge of 1031 exchanges, and we're going to look at something called a Delaware Statutory Trust. You'll commonly hear it referred to as a DST. In the tax world, we have so many acronyms. So when you're at your real estate meetup or you're at your next cocktail party or your kid's soccer, baseball game, oh, yeah, you hear about oh, I had this apartment building, I did a DST. And now you could shake your head and say, oh, gosh, I know what that is. So thanks for listening. But I'm really excited to jump into Delaware Statutory Trust. So we have from ExchangeRight, who is a company that I've done business with and our private CPA firm's done business with. Amazing to work with. Warren Thomas, a recovering practicing CPA, had his own practice. And he's from, well, we all know if you're a sports fan where the Tournament of Roses is. Joining us from Pasadena, California today. Last time the Michigan State Spartans were there, they did walk away with a victory, although that was a long time ago. But welcome, Warren. How are you doing? And thanks for joining us.
Thank you. Yes, I'm doing well, and I am in Pasadena today, and the weather here is about 82 degrees, so that's a good place to be.
Maybe you can get out on that golf course next to the Rose Bowl. I don't know if you golf, but
I've golfed badly for 50 years, so yes.
Most of them,
if you're running a charity tournament, I'd be interested in coming and playing as long as it's a best ball foursome, and you can use me for putting or something like that.
No, I empathize. I would be searching for the pickleball courts, as everyone knows. And John, yes, we're 5 minutes in, and I've already mentioned pickleball. I usually try to avoid it at least till
Good work.
get
Good work.
halfway
You know,
through.
yeah, usually you wait until the end or at least the last 20% of it. So you must be very ambitious today.
Well, I've been out on the courts a lot. Well, Warren, can you give us a little bit of background about yourself and how you kind of got into exploring opportunities with the Delaware Statutory Trust, and then we'll jump into what kind of animal we're even talking about.
Yeah, happy to do that. So just my background, I started as a CPA and auditor with a company called Ernst and Young, which is now Ernst and Young. And then that was quite a few years ago, but I then founded a CPA firm in Southern California, ran that for 25 years. It was primarily a small business and tax practice. And so I have CPA, I have master's in taxation. But by the early 2000s, we were working with quite a few investors that were engaged in 1031 exchanges. And so we began doing due diligence on a number of companies that were bringing out programs for the 1031 exchange investors. So we were reviewing all sorts of asset classes from hotels to office to multifamily to oil and gas to net lease, and really got our education by doing due diligence.
Well, so you were kind of on the other side of it, right? You're looking on behalf of your clients, and you mentioned something interesting that a lot of times people don't really understand about 1031 exchanges, and again, we're going to jump into DSTs in a moment.
Right.
That when we talk about a like kind exchange, which means you're selling a real estate or an asset, a real estate asset, and acquiring another real estate asset. There's a lot of misconceptions on what a like kind exchange is, and can you exchange from, maybe you own a single family home and you're looking to get into even a mobile home syndication. Okay, are
Mhm.
you allowed to kind of mix and match asset classes?
Yeah, you sure are. So, a like-kind exchange, like-kind can mean a property held for investment purposes or for business purposes. So, you could go from a apartment, or a lot of our investors have single-family rental properties, and others might have, a 30 unit or whatever it is. But the basic character of being held for business or investment purposes is the same regardless of the asset class. So they could actually move from that residential rental into an office building, into a trailer park, into any of these other asset classes, and they can also move from owning that individual property to owning a piece of an entity that's called the DST, the Delaware Statutory Trust. So it's really provided investors with a great amount of flexibility that they wouldn't have had years ago. And the DST was developed actually through a revenue ruling in 2004. So for the last 21 years, it's been part of the tax law history, and now it involves many billions of dollars a year of investors' capital that are typically coming out of active management and wanting to get into an institutional type asset class that might have more predictability, more stability than what they have been engaged in with their personal rental properties.
So, and this is a really good point, because we find a lot of people, a couple misconceptions on 1031 exchanges. We might hit all three of the laws of teaching tax law. One of them is cash flow and tax flow are different. And what I mean by that is, let's say you bought a single family home for $500,000 as a rental property. You've owned it for several years. It's now worth $1 million, and you have a note on it of $200,000. And let's just say there's no closing costs. You sell that for the million. You pay your loan off for 200. You're left with 800,000 of cash at closing. To complete a full 1031 exchange, you actually have to deploy $1 million, right? You can't just take the $800,000. And but what can happen is life can change. Life can change where something called your bankability isn't what it was before. Interest rates are higher. I've run into a lot of situations where we have early retirees that have millions and millions of assets, but they struggle to get financing because don't have a lot of recurring income. And I think that's a really nice case for a Delaware Statutory Trust. So, as you said, about 21 years ago, there was a revenue ruling
Right.
that allowed, and make sure I'm saying this right, a Delaware Statutory Trust, or DST, to qualify as a 1031 exchange asset. Is that fair
Yes.
to say?
That's correct, and there is a difference between a Delaware Statutory Trust, technically, and I know we don't want to get too technical here, but it's a grantor trust, similar to having your living trust. If you and your wife have a living trust, and you hold your assets in that title, IRS sees that as a what we call a disregarded entity. They don't count it as though it's a corporation or a partnership, which may have restrictions on doing a 1031 exchange. So under the Delaware Statutory Trust, they see it as just a pass-through entity. You can go from owning a single ownership of a rental to going in and being, you might be one of 30 or one of 100 owners of a very large diversified portfolio. And to your point, you mentioned about qualifying for loans. If you need a loan, these DSTs are often structured with loans so that you don't have to qualify. If you're no longer bankable for some reason, you can't get a loan in the future, and you need to place that 800 grand, but you need 200 grand of loan, those are built into the DSTs, and you don't have to submit tax returns. You don't have to submit the financial statements to qualify with the bank. They're kind of built into the process. So the DSTs can solve some practical issues that some folks have on qualifying for a 1031 exchange. So they're quite handy.
Right, so we'll build on that. So
Yeah.
and it could be someone maybe they just don't want to have that debt on either. At least on their
Yeah.
as a traditional loan going through those traditional banking outlets. So talking through, let's talk through my for example I just came up with. Let's say we have a taxpayer. They sold that property. They have $800,000. First of all, if you're going to do a 1031 exchange, you can't let that $800,000 hit your bank account. You're going to have to use something called a qualified intermediary. Or you know what? Remember those acronyms. So if you want to seem cool at the baseball field, that's a QI. You want to get a QI involved. They're going to hold that money for you until you can find what's called replacement property, and that's where the DST comes into play. So, Warren, so in that case, so we've got someone that's looking to place a $800,000 for the cash,
Mhm.
but ultimately they're placing $1 million, so they get
Right.
credited for $1 million in that exchange, and then they get allocated a certain amount of debt from the DST.
Yeah, yeah. So we like in our case, we build DSTs that have no debt, and we build DSTs that have very modest amounts of debt. Now, if you need a lot of debt, my company, I build our programs for the retiree. So there'll be other programs that you know about, and you can introduce folks to that might be more aggressive than what we do. But my average investor is about a 72-year-old. They typically are a retiree that's made most of their money through real estate. So for those that need debt, they'll come into a package that already has debt. And the use of debt's quite interesting because we have investors that come to us that actually have no debt or they have very little debt, but they're looking for a program that has debt, right? And why do they look for that? Because that debt, if they came in with 800 grand and they went into a program that had 50% debt, they're now buying about $1.6 million worth of property, not just the million that they started with. And so that extra 600 grand worth of property can be depreciated and can generate extra tax deductions that go on year after year after year. And because of the nature of that debt, where they didn't have to qualify for it themselves, and it is what we call non-recourse. It means they can't go back after your private assets in order to, satisfy that debt. You basically have levels of protection, and you get that ongoing tax sheltering that can go on forever. So there's reasons to consider maybe using a debt DST, even though you might not have much debt or you might not have any debt. On the other hand, we've got investors that say, hey, I bought this property 30, 40 years ago. I've paid it off. I'm now at an age, I just don't want to go into anything with debt. And so they don't have to. We've got debt-free DSTs. You've got them on your shelf, they're available. So either way, we can plan for the needs of the investor and for the risk profile of the investor.
So you can go in, like I said, yeah, you can go in debt or no debt. Rule of thumb, it sounds like that typically people going into the DST program is someone that is let's say in their retirement years. Rule of thumb, there's probably something and I'm sure there are a lot of DSTs out there, right? And what we're going to talk about that in just a couple of minutes. But what is typically the average amount of loan to value or debt percentage that's
Yeah,
acceptable the most?
great
Because they
question.
can't be
So,
over leveraged, right?
right. So it depends on the asset class. So our specialty is net lease. So net lease is like triple net properties, double net properties. And then within that specialty, I will only buy those that are investment grade, meaning the corporation's standing behind it, and that corporation has to be a high credit quality. And so I've got over 1,300 properties in all of the DSTs we've done, and we've never had a missed rent payment. That's pretty incredible, but it's reflective of the type of asset that I buy. So you're going to find other DSTs that may be buying other assets that have different characteristics of growth or what have you. So in our programs, when you look at debt, how much debt is appropriate? Well, just as I'm buying assets that tend to be more conservative by nature, I'm also going to limit the amount of debt I use because I know my typical investor is going to be a retiree or pre-retiree. So I just want to be mitigating risk. But directly answering your question, I will typically be at a 41 to 46% debt load on my debt programs, and then I'll have those that have no debt. If
Okay.
this were 3, 4 years ago when the cost of debt was really cheap, I mean, I was getting loans at 3.3% for 10 years, right?
Hmm.
Sometimes it would be 3.6, 3.8. Well, now
Right.
debt costs you 6, 6.25. I don't want higher debt. I want to
Hmm.
moderate my debt, and I want a lot of cash flow available every month to not just cover the debt, but to far exceed the debt. And it's called a debt coverage ratio, and I want to be really healthy on that. So that's the way I use debt. Other sponsors, other companies will use it in different ways.
Well, and I know so, and that's something to consider if you're thinking about the 1031 exchange. Let's remember that I'm going to harken back to those prior episodes and some of our content, but you've got to identify property, replacement property, and there are some strict timelines
Right.
to close on that replacement property, and that's why putting it, like the DST as a replacement property option when you might have to pick up debt, or even if you don't have to pick up debt, is a very viable option because there are many risks that you're not dealing with, such as not closing. In our private CPA practice, that real story, we had a client from California, sold a very highly appreciated asset, was purchasing 8 properties for that asset. So remember, if you're doing a 1031 exchange, it's not one for one, but was purchasing 8 properties and identified, I think, 10 properties. And what happened is they weren't the higher value properties, we'll say, but the lender pulled out because the inspections were so bad, and it blew this whole deal up. And
Yeah.
had that person identified a DST as an option as replacement property, they could have backfilled some of the replacement property, if that makes sense. So
Yeah,
it
yeah,
really gives
that
you a lot of
because
flexibility.
that's a real risk. You only have 45 days to identify what you're going to buy, and if for some reason that property fell out, like in your case, that lender, but if you go to a DST, it's like I don't bring a DST out until the day that I purchased the number of properties that are in that DST, so they're not at risk of not closing. You know exactly what you're getting. You know the lease lengths. You know who the tenant is. You know the cash flow. You know the debt terms. All of that's already pre-done by the time it comes out as a DST. So it takes a lot of that risk off the table for the investor that is trying to work with that 45-day ID requirement or the 180-day closing requirement, which we didn't really talk about that. So I'm assuming the listeners already know about that, but there's some rules you have to be really careful of. And then you also have to be careful of IDing because there's 3 different rules on IDing, and we don't need to get into that on this podcast, but you can utilize a DST as a safety valve.
Exactly. Bottom line is you can't go into Zillow and it's ID a million properties just because when you start you've got to close on a certain percentage of either the property's ID or property values, and that's where a qualified intermediary plays a huge role. And now I know you can only speak for ExchangeRight. In general, what are some of the minimum amounts to enter into a DST, because especially if you're using, let's say you're using multiple properties as replacement property.
Yeah, yeah. So on the minimums, most of the DST programs are going to have a stated minimum of 100,000. And I'll just use ours as example. We've had 9,000 investors come into our programs. I didn't mention it at the beginning, but I founded a company called ExchangeRight, which is reflected by the banner behind me, the colors. And I founded that in 2012 with two partners, and we grew by 40% per year for the next 10 years and became the third largest DST sponsor in the country. And with that, we have programs that have assets in 47 states, and they're net lease assets and all that we've already talked about. When you get engaged with a sponsor, you want to make sure that they've got the program available to you and that they know what they're doing, because the risk is really, it is with the sponsor. I'm probably not answering your question directly, but that's a little bit about the DST industry. Has a number of sponsors in it, all sorts of different asset classes, and all of them are trying to solve the common investor requirements.
Well, no, this is so I think we've covered if you're in a situation where you're looking for replacement property, this is I know this. I've been doing this for over 20 years. Can you invest in a DST outside of a 1031 exchange transaction, or is it
You
specifically
you
for 10?
can,
Okay.
and that goes back to your question was actually on minimums, and
Hmm.
I didn't answer that question, but stated minimums are usually about $100,000. But when I get a $5 million investor, if you came to me and said, "Hey, I've got somebody who's got 47,000 and they need to ID and they need to buy," I don't really care, because at the end of the day, for us as a sponsor, it's just spreadsheet work. And the $5 million versus the 47, yeah, it doesn't really matter. But most sponsors will limit it to 100,000 minimum investment size.
No, that makes sense. Um, so we talked about kind of getting into this, and we're going to wrap this up because I want people to think a lot of times with tax planning and strategy and investments. You think about, man, this is a really great transaction. I'm good. Take a breath. It takes a lot of stress off. But there are some other benefits on what happens 5 years down the road, 6 years down the road, 7 years down the road. You mentioned obviously there's sometimes, a lot of times there are actually tax advantages using that leverage where you can't depreciate tax deferred money, but if you do take debt on, you could see some depreciation deduction. So the income could be tax favored. But down the road, let's say you do invest in a DST and that they own a property that doubles in value and sells. Is someone going
Right.
to get stuck with that tax bill, or do they have options?
They have options.
Mhm.
So, they come into the DST because they may be going from where they were actively managing. It might be because of age. It might be because they want to have retirement days and vacations and things that they can't get while they're doing all that maintenance. It might be because the cash flow is better in a DST than it might be owning your rental property. And it might be they're trying to create new tax deductions, but they want to hang on to the property. They want to hang on to rentals because they get a step up in tax basis at
Mhm.
death, and they can pass that then to their heirs without having a taxation on it. So that's the motivation for the 1031. So now they're in a DST, and the DST has a full cycle event coming eventually, right? So some DSTs, like we have a whole series of DSTs where the full cycle event occurs before year 5. Okay. So some other companies are going to go year 7 to year 10, as you mentioned. But at that full cycle event, what are their options? So in our programs, we introduce to the industry the concept of multiple exit options from the DST. So our DSTs, depending on whether it's an all cash DST or a levered DST, the common three exit options are: one, cashing out. An investor, we believe, should always be able to just cash out. The reason that's important is because the retiree, the pre-retiree that's coming into the DST, they're going to be in that DST if they needed to cash out, whether that need is because they had a death and they get the step up and they really don't need to do exchanges any longer. We want to give them that option. So that's option one. We only get about 10 or 11% of our capital that wants to exit when the DST goes full cycle. Option number 2 is doing what we call a 721 exchange. I know that's something you wanted to talk about today, but a 721 exchange allows them to take their DST interest, roll it into a much more diversified program, which is a REIT program or an operating partnership of a REIT. And for those that have never heard of a REIT, it's a real estate investment trust. And a 721 exchanges take the property of the DST. You have the option. Do you want to roll it to the REIT? And if our DST had 8 to 20 properties in one DST, the REIT, currently we've got 362 properties. So do you want more diversification? Well, maybe so. And why would you want it? Well, theoretical risk mitigation. The more diverse, the more theoretically risk mitigated it is. But second, that the DST, which is generally an illiquid investment, you move it over to the 721, and the 721Rs, they'll have quarterly liquidity. So if an investor that's done a 1031, he's rolled to the 721 when that was available, is getting paid cash flow every month, might even be more cash flow than they were getting in the DST or more cash flow than they were getting in their old rental. But now they have opportunity for liquidity. So let's say the kitchen needs to be remodeled. So you guys are married, your wives say it's time to spend that 40 grand. Well, instead of having to cash in that whole DST and pay tax on it, you can be in that 721 and say, okay, this quarter we're going to cash in, 20 grand to get it started. And next quarter, maybe it's another 20, or you decide to cash in all 40, or a death occurs while you're owning that 721, and you're going to get a step up in tax basis in the 721, and you can now say, hey, cash in the whole thing, and there's no taxation to pay. So now you can get off of that train. So that cashing out of the DST is one option. The rolling to a 721 is a second option. Or for some investors, they want to continue to do 1031s. So we get about 30% that want to do another 1031. We get about 60-something% that want to do 721. And we get 10 or 11% that cash in from the DST. So that's kind of a quick overview of it. But we can dive in further to any of those angles.
Right. I think we might have to have another podcast just on that, the
Yeah, I think
721.
so.
And I think that, so here's the thing, guys. If you're thinking about this now, I'm going to date myself a little bit. Back in the day when you went to a hotel, well, even before credit cards, my parents would break out those traveler's checks, but you ultimately maybe would arrive, you'd put a credit card on file, and then you would pay for your room and for all of your, goodies that you got throughout your stay when you check out, right? Well, guess what? If you never check out of the room, you could live there forever and never pay. So think about that with your real estate. Think about those options you have as, hey, I'm in this property. I can 1031 and get a DST. I can move over to a REIT. As long as you're using the right people. That's why thank you to Warren and his amazing team at ExchangeRight. We talk about implementation partners and people, we talk about all the time. Ideas are cheap. You can find them on TikTok, Instagram. Implementation is important. So thank you for coming on the show. You are one of our valuable implementation partners. I learned a lot, and I think we've got some ideas for more topics. John, what do you think?
Yeah, absolutely. It's funny, if anybody who's watching this has probably seen me, kind of doing one of these. I got my trusty little pen out here, burning holes in my notepad.
Yeah, I wrote some stuff down too.
And honestly, Warren, it's, coming into this, I didn't know a whole lot about DSTs. I knew, enough to be dangerous, which is why I keep Chris in my life for 20 plus years. That way I can get dangerous and he can save me from it. But it was really interesting to me, and you did a fantastic job about explaining it, right? Like, there's different outs, if you will. There's different options. It's not just, you get in, you lock it, and you're stuck there regardless. I mean, sure, there's time commitments regardless, but thank you so much for diving into that detail. I think that'll surprise a lot of people.
Very good. Very good. Lots of estate tax advantages we could cover on another podcast to both the DST and the 721 exit. So happy to go over that in the future, but it's been a privilege and just pleasure to be able to be on here with you today.
Absolutely. Well, thanks for joining us. And yeah, now that you said it and everybody heard it, we're putting the hook in you. So now you have to come back and join us. We'll just let you know when we're going to do it. So
Okay.
we appreciate it. Chris, thank you as always for coming on your own show. Obviously, it's kind of a requirement, if you will. AI is pretty intense, but it is very hard to duplicate your voice and your glowing personality, sir. So we have to have you keep coming back here. We
I was
can't let
waiting.
you
Well,
off.
yeah, exactly.
Although we can edit out, when you say pickleball,
Well, I
once
thought
per
you were going to
episode
say
is
my
good.
glowing head. I thought the ball joke was coming, but that's all right.
No,
We're all
I cut
good.
those off at about episode 100, so I've given you a little break.
Uh,
But yes, everybody who's listening or watching to this, definitely subscribe to the channel here on YouTube, as well as if you're not familiar with it, we are on Spotify, Apple, iTunes, pretty much anywhere that you can possibly find a podcast. This one is streaming on, so be sure to check it out. Go back. We'll drop some of them that we referenced during this specific episode of previous ones. I know we talked about the 1031. We'll drop that one in here, a little quick link for you to go and find that. And as always, we'll see you back here next week. Roughly same time, different date, and completely different topic here on the Teaching Tax Flow podcast.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.